We start today's market talk. The key question right now is, can Trump walk away from the Iran war? This is the foremost question which is there in everybody's mind because firstly you have to understand that this region is very important for US interests because choking off Gulf oil exports or threat of doing so is a key for US in any conflict with China. Now, walking away at this stage will leave the Iran regime intact, and Iran will retain control over Strait of Hormuz and leave American allies in the Gulf in the lurch. So it is not that easy for Trump to walk away from this conflict at this stage. So he could have walked away slightly before. Hence, any bullish talk, any talk of ceasefire, take it with a pinch of salt. Now, the problem is market thinks this war has an early exit, but the structure of conflict suggests otherwise. And that is the dichotomy where people are getting stuck. Because the reason is there is no off ramp, there is no place for Trump to get out in this conflict with a victory. Hence, he is threatening to bomb Iran back to the Stone Age by targeting civilian infrastructure right now. Markets are not pessimistic right now because Iran is keeping Hormuz open for ships from friendly countries, and market has a faith that in Trump's taco abilities, that ultimately Trump will chicken out. So that is why the markets have not collapsed. But the structure of this conflict is pointing to the pointing the other way. A ceasefire without structural constraints on Iran's nuclear missile, drone, and proxy networks effectively normalizes a persistent threat environment. Now, the Gulf states would face a scenario in which Iran retains both the intent and capability to target economic infrastructure while benefiting from reduced immediate pressure in case you have a ceasefire with present condition. Now, entries of Houthis into the conflict represent a critical escalation vector. Their capacity to disrupt Bab el Mandab Strait, this is Bab el Mandab, this is the one which is coming through Gulf Red Sea. So that is the alternate route, while Saudi Arabia has an alternate pipeline which runs like this. And then so they are trying to send oil from here if the Strait of Hormuz is disrupted. Now, how these get active here and start targeting this zone. So now what happens is, this creates a critical escalation vector. It introduces a second choke point along with Hormuz. Iranian proxies embedded across Lebanon, Iraq, Syria, and Yemen are likely to intensify their activities now. Now, we remain at the whim of a US president whose strategy is not clear or unclear at best, and an Iranian regime that is not backing down. So the stagflation risk is back. Now, stagflation, for your information, is when the growth rate of the economy is low and the inflation is high. Hence, the central banks cannot cut rates because inflation goes up. So they are in a dilemma as to whether to cut back on inflation or to support the growth. So that risk is back, and we are already seeing it in stocks, bonds, and currencies. Investors need to be prepared for the possibility of lower growth and higher inflation, and you can see that in India's bond yields. So if you see, India's bond yields were up 2.84% just last week, straight from 6.8. Last week there was a spike, and now it has reached 7.129. So now if you see, and this is despite 125 basis point of rate cuts by RBI. So what it is telling you is that there is no possibility of rate cuts. The bond investors want higher rates. They are not ready to put money at 6.5 or something like that. They are asking for higher rate. So they are not bothered about what is the repo rate and all that. And this trajectory means it is heading higher. So the peak was somewhere around this 7.6 or higher level. So once it reaches there, then it will start impacting everything else. So even if military activity ends soon, the impact to growth, inflation, and commodity prices could linger. And the longer energy and commodity supplies remain disrupted, the greater the potential economic damage. Now, energy shock is large, Strait of Hormuz is disrupted, and oil prices have moved up sharply. Higher energy prices seep into transport costs, food prices, utilities, and entrench inflation. Stagflation is uncomfortable. Consumers demand reduces oblique dampens while headline inflation rises. That leaves central banks to see if growth or inflation is coming down with few viable options. So now you have a MPC committee meeting on 8th. We will see what they say and what is their outlook, etc. For India, combined impact on growth, inflation, fiscal balance, and external balances is likely to be significant. So, what is the threat? Firstly, your growth would be lower. So, there is a more disruption in overall economy and companies' earnings. Inflation would be higher, so the cost of living goes up. Fiscal balance, higher fiscal deficit, so the government has to borrow more. That is what is being reflected in the bond yields. And current account deficit, that is external balances. So if you're importing higher and exporting less, so your current account deficit is higher, and that is being reflected in the price of the rupee. So rupee is declining because of that. Now, what MPC can do, they can delay further cuts or even think of a rate hike to guard against inflation. Now, in an environment of uh, uh, declining rupee, it is importing inflation, and now in case they cut rates to support growth, the rupee will decline more. So it will stifle. So if you raise rates right now, it will stifle investment and consumption at a time the global scenario is adverse. So right now they are in a big dilemma. But the what market is not pessimistic because they know that Trump will find a way to claim victory and end this. It will be obvious to most that he has lost, but it will not embarrass him as he does not admit failure. This is the only hope on which the market is right now surviving. So I showed you what is this choke points, government bond yields. Now the rupee had declined to around 95 level, as I was mentioning, and then RBI surprised the currency market and made banks restrict the size of bets they can take on dollar rupee pair in the onshore derivative market. But this is temporary because right now they are closing their dollar position, the banks, and it has corrected. Rupee has actually appreciated, but currency would resume its depreciation due to impact of war on trade and on dollar flows because restricting trading in onshore derivative market will not reverse the tide of dollar outflows. So dollar outflow is the reason for the decline in the rupee. That is not changing. FIs will not stop selling. They are now selling at $1 billion every day. Okay, we'll see that. So now FIs DI data. FIs are short on index futures. They have sold calls, bought puts in index options. They are strongly bearish and are selling in cash. Every day, 8,000-9,000 crore they are selling. Pros, long in index futures. They have bought calls, bought puts in index options. So they are mildly bullish, you can say. Clients, long in index futures, bought calls, sold puts. So they are strongly bullish. Now, if you see here, full month from 2nd March onwards till date, FIs have sold roughly around 1.5 lakh crore. So, and every day the selling is now for the last 3 days roughly $1 billion. So that is what is impacting the rupee. And last 3 week trading days of the week, you see first day we had a 2% fall. Then there was some short covering, and then market rose a bit till end of the week. But people are scared to take both positions on either side. Hence, there is some short covering at end of the week. But again, these shorts which are existing in the system will pile on during the day again on Monday. Now coming to the US, so if you see there was some bullish commentary from the Fed, etc. So the US bond yields came down, but nothing significant. And their jobs report was strong, even though geopolitical tensions are pushing the crude prices higher. So dollar is at 100 odd level, not much movement. Brent crude is now reached that 109, 120 level, but this is just Brent crude. The actual crude which is coming, which countries are buying, are at 140, $150. So that is the actual cost. Now the basic thing was, if you're buying it earlier at 60 or $70 a barrel, and today it's at 140. So people say that if the price of crude goes up by $10, you can shave off 0.4% from India's GDP growth. So straight away you can take out 2 to 3% from the India's GDP growth, and that is the risk. So the upper limit should be somewhere around this $125, and after that we will see, because after this there would be a big demand destruction and all those things will take place. Gold has kind of bottomed out, and now it is trying to move up. Let's see. Similarly with silver, it has taken support at that $70 level, dollars to the ounce level. Copper again rebounded after it sold off for 4 weeks. So again, we'll have to see. But in case there is a recession in the world, etc., so these will all sell off. Bitcoin is again in a bear market, till the time it is below the 70,000 level. So it is also surviving right now. So the US indices ended higher due to, as I told you, stronger than expected March jobs report. So the Nasdaq bounced around 4% last week. S&P 500 was up around 3.5, and Dow was also took support at the level from which it had risen after the Trump had come into power, and has taken the support at that 45,000 level. So we'll see what happens. Now India VIX has breached the level of 2024. That is the crisis which took place at the time of Ukraine crisis, Ukraine-Russia war. So it has reached those levels. Now, if it remains at these levels, don't expect any recovery very soon, because people are scared and people are buying protection on the short side. Hence, that's why the VIX is going up. So you will get a lot of volatility intraday, overnight, etc. Now Nifty, if you see here, it just consolidated last week because there was news and a shorter trading week. But the first line of support is somewhere around this 21,800 levels, or 22,000. So 22,200 was the low, somewhere around that last week. Once this low breaches, then it will head lower. So the first line of support is this 21,800, and the second is the election day low of somewhere around 21,250, which it made in May of 2024. So we'll see. Now in terms of daily charts, so if you see decline and then rise on the second day of the week, and then decline again and a bounce after a short covering after that. So, but the trend is downwards. You're making lower highs and lower lows. So it is heading downwards, and the channel is coming to around 21,800. So we'll have to see. Now, if you see the hourly chart, you can clearly see the channel. It goes to the top of the channel, declines, tries to goes up, and then takes resistance at the top of the channel and comes down and makes lower lows. So till the time it doesn't gets out of this channel and makes higher highs, there is no change in the trend. Similarly with Nifty Bank, again down around 1.39%, but didn't really made a lower low, took support at 50,000, but with this trajectory, it is heading to this support of 48,000. clearly. This is the weaker part. In terms of daily chart also, same. It took support at 50,000 on the last trading day and then bounced from there. The problem with HDFC Bank, the problem is not finishing. In my opinion, I think somewhere around 700 it should go. That should provide some support. Unless there is no incremental negative news, it is oversold. Their business updates are normal, nothing great. 12-15% growth. Other smaller banks have grown much better. Similarly, with Reliance, Reliance sold off last week after the government had raised the uh, duties on exporting. It bounced back a bit, so we'll have to see what happens here. But somewhere around 1300, 1320 should be a support. Now, IT is bouncing back. Infosys gets a support at around 1220 odd, but one must wait for the earnings season and the management commentary, because there I don't think there is any positivity which is going to come out from here. Uh, Midcaps, again, same. They are relatively stronger as compared to Nifty, etc. They have not made a fresh low. Small caps also bounced from this support, which was at around 14,900, and it has bounced from here. You can see if these can rally. So the basic thing is that FIs are selling aggressively. Uh, as I told you, cumulative outflow is around 1.5 lakh crore in last month, and they have dominant short positions. So, and we haven't seen any meaningful short covering, despite some pullback in the indices. So they have maintained their short positions in terms of index options and uh, index futures. Nifty is under pressure, trading below all short-term and long-term moving averages. So we'll have to see. Immediate resistance will be up to around 23,000 level, and support, as I showed you, around 21,800. So we'll see what happens from there. I'll cover two stocks. First is Varun Beverages. It's a key player in the global beverage industry and the second largest franchisee of PepsiCo in the world outside US, with operations spanning across 10 countries with franchise rights and additional 4 countries with distribution rights. So if you see, firstly here, it has had a volume CAGR, sales volume CAGR of around 23% over the last many years now. And what is improving is the international sales, because India business is getting matured now. It is becoming kind of a stagnant. Hence, the growth is now coming in the international business. It is in all states of the country, Nepal, Sri Lanka also. It is now moved into Africa and various countries there, so as to increase the business and seek opportunities there. Uh, India's beverage market has scalable dynamics and is set for decadal at least 10% growth per annum. So now we have matured, and now we have reached. Earlier, this company used to have 20-30% growth. Now it has reached that 10% growth. The advantage of beverages is that the tastes are uniform. So you can scale the business, unlike the snacks, because every part of the country has a different taste in snacks. So you can have centralized manufacturing and distribution, and you can sell. And the core scalable categories are carbonated soft drinks, bottled water, and juices. So, in my opinion, the bottled water is the highest growth sector. Growth enablers which Pepsi has done is they have expanded their cold chain infrastructure, improved their logistics, storage, etc. Send their coolers everywhere, so every shop you will see them, uh, and uh, they would be having an advantage due to improving rural electrification and favorable demographic trend. So they have certain brands licensed from PepsiCo. So carbonated soft drinks, club soda, fruit pulp, juices, energy drinks, sports drink, carbonated juice-based drinks, iced tea, packaged water, snacks, etc. And their own brands of soft drinks, energy drinks, packaged water, and dairy-based beverages. So it is evolving from a regional bottler into a diversified global food and beverage compounder. In India, its manufacturing and distribution modes protect against share losses arising from price aggression of Campa Cola. Growth will be driven by pan-India consolidation. So in India, Campa Cola has just got 2% market share. So it is not that kind of a threat. The reason is Pepsi has good and Varun Beverages has good manufacturing and distribution networks. Internationally, it is building a pan-African FMCG network, replicating its India playbook across South Africa, Morocco, and Zimbabwe, while expanding into snacks and alcohol beverages optionality to drive profitability. South Africa, there is no restriction on selling alcohol type beverages. Hence, that is an opportunity there. Its capital mode, that is strong visi-cooler density, a decentralized 38 plant network that creates cost to serve advantage, positions it for multi-year EBITDA accretion. That is the advantage it has as compared to Campa Cola, etc. Both Nepal and Sri Lanka now operate with established localized capacities. They are generating strong free cash flows, effectively shifting from a phase of heavy capital investment to lucrative cash repatriation for the parent company. It officially entered the South Africa market in March 24 by completing the acquisition of the beverage company. This deal gave it five poorly maintained but highly strategic manufacturing plants alongside franchisee rights for South Africa, Lesotho, and Eswatini, and distribution rights in neighboring countries like Namibia and Botswana. So now if you see, this is penetration. How much is the product penetrated into the Indian market, and what is the expected 5-year growth CAGR? So there is an ample growth headroom in the beverage supported by low per capita consumption and larger share of unorganized segment. If you see here, flavor milk drink, though expected CAGR is less, but penetration is less. Similarly, bottled water, expect penetration is very less, but expected 5-year growth CAGR is around 20% plus. Carbonated drinks, decent penetration, so expected CAGR is around 8-10%, and rest for everything else. So here, in terms of FMCG, most of the products are now fully penetrated. So that is why all of them, like spices, milk, tea, rice, pulses, salt, cooking ingredients, edible oil, the biscuits, etc., the chances for growth reduces because everybody who can consume is consuming it. So that is the problem. Hence, the growth CAGR is 8-10% now only. What Varun Beverages has done, it has evolved from a largely North India-based bottler in calendar year 15 to global diversified food and beverage company. Firstly, initially it was a regionally focused North India player. Then it scaled as North and East India into other parts of and then also tried some international entry. Then it did national consolidation, got into the eastern and the southern parts of the country. Now it is in the global expansion and portfolio scale up, getting new products and trying to grow in South Africa and Africa. So that is how they scale their business, and that is where they're. So this is in millions. So roughly, they are reaching around 25,000 crore of revenue per year. Now, their international portfolio has evolved, indicating a strong focus on African markets because, say, in calendar year 17, they were more focused on Nepal and Sri Lanka and less focus on others. But over a period of time now, so if you see here, they are mostly in Africa. See, Zimbabwe, Morocco, South Africa, and Congo. So they have grown into these parts of their international portfolio is evolved more into these countries. So they expect a growth CAGR of around 13%. Now, if you see, the key point is they were growing in calendar year 21 and 22 at 40-50%. And that's why they were having high valuation. So you don't need to see the previous PEs oblique prices because now the growth expectation is around 12-13% with steady gross margin profile of around 50-55%. Volume growth is expected to expand at 12% CAGR over calendar year 26 to 28. And domestic sales still form around 59% of consolidated sale by calendar year 28. So If you see here, the domestic sales is around 59% and the balance is international sales. So they have understood the limitation of the Indian market and have moved on to other markets. So now if you see here, in India, they are expected to scale VBL sales to a scale at around 14% CAGR over the next 3 years, driven by 13% volume growth and 1% realization growth. Net sales in India are expected to grow around 10%. Net sale international are expected to grow 17%. So there they are getting the growth from. Gross margin would be limited due to higher competitive intensity in India. EBITDA margins to remain flattish. So if you see here, EBITDA margins are remaining in this 23% category. And so don't expect outstanding kind of growth in profits and other issues. So revenue growth, as I told you, 13-14%. Profit of around 4,100 crores. PAT growth of around 18-19%. EPS, they would do around 12.2. And calendar year 28, that is calendar year 27, and 14 in calendar year 28. So taking around, let's take around 12 and a half or 13. At 30 times at 370 to 390 is a fair value for this stock. Gross margins are steady. EBITDA margins are again steady. There is not much of growth expected. And net profit margins are also, basically efficiency is coming, so they are slightly improving. And it is at around 30 times calendar year 27 expected earnings. So we'll have to see. So if you see here, this stock went in 24, it went up to around 675 odd and has been continuously declining. And now, even in weekly charts, it's below 200 EMA. So in my opinion, roughly 360, 370 odd is a decent level to buy this stock. But this is more like a defensive stock now. Don't expect too much of a jump or it'll again go back to 500 and all, because it has been on a declining trajectory, and last summer was bad, and that is the reason why the stock declined. So now it gets impacted due to all the weather related issues also. Now the other stock is Lloyds Metals and Energy. It's a leading player in the iron and steel making industry with its operations spread around Nagpur, Maharashtra. It is the sole iron ore miner in the state of Maharashtra. It continues to be India's lowest cost iron ore producer, benefiting from legacy mining rights without auction-linked premiums, an advantage unmatched by peers and sustainable over decades. The commissioning of 85-kilometer slurry pipeline has significantly reduced logistic cost and improved the sweating of mining assets. I'll explain this later. Iron ore production surged from around 21.96 million tons, a 120% year-on-year increase from 10 metric tons in FY25. So they have nearly doubled their iron ore production in 1 year. The target for next year is around 26 million tons. Shifting from raw ore to pellets, direct reduced iron, that is sponge iron, and eventually wire rods. These are value-added products. So EBITDA margin has expanded to 35.85%, a significant jump from 32% in the previous year. The value-added product mix is pellets now contribute nearly 15 to 20% of the revenue compared to 0% a year ago. Acquisitions follow two distinct. Now they are doing a lot of international acquisitions, basically consolidating its domestic mining operations and expanding into green metals, copper and cobalt in Africa. So in FY30 expected steel, MDO, which is mine developer and operator, they acquired a company like that. Pellets and copper will drive bulk of the earnings, sharply lowering reliance on volatile iron ore prices and improving earning stability. It has acquired a 49% stake in virtuous Lloyds Minerals Holding (VLMH) for $30 million. Now this is VLMH holds 100% of CHEMAF, which owns 50 plus copper and cobalt mining permits in DRC, that is Congo. The transaction is part of a broader US-led push to secure critical mineral supply chains and reduce reliance on China, supported by US DRC Strategic Partnership Framework. At peak combined capacity, it would reach 100 kiloton per annum copper and 20 kiloton per annum cobalt, along with 50 million tons per annum mining volumes by Triveni, one of the companies they acquired, driving product and geographic diversification. So if you see, when I was talking about integrated slurry evacuation platform, they have mines at Surajgarh iron ore mine. From there, they run is moved through a pipeline network to Hedri plant, where slurry is prepared and transported onwards. From Hedri, the company is developing a new slurry pipeline to Konsari, 99 kilometer, with planned capacity of 16 million tons per annum, building alongside the existing 85-kilometer Hedri-Konsari pipeline that is already operating at 10 MTPA. Now with this, it goes to their Chandrapur stockyard. Extend from Konsari to Chandrapur stockyard, 72 kilometer, completing a corridor from mine to dispatch with limited manual handling. So it cuts down the cost of transportation and it then goes to their plants. It will lower logistics costs, deliver cost saving by around 800 to 1000 rupees per ton, and stockyard at Chandrapur saves further 250 per ton on external sales. Now this is how they are from mine to market without friction, trying to increase their output. That's how I showed you their mining output and other things have increased. Now they have done certain acquisitions. They did acquisition of Triveni Earth Movers. Now this is a MDO, mine developer and operator, basically involved in exploration and excavation to mineral processing and logistics. So they do exploration, excavation to mineral processing and logistics. So they acquired that in July 2025, 79.82% stake, vertical integration and mining operations and equipment. Now through they have acquired another company, Nexus Holdco FZCO, December, 50% stake. This is entry into DRC, copper, cobalt mining. Then Virtus, Lloyds, ChemF, March 2026, 49%, major expansion in energy transition metals. Then TP Phoenix, South Africa, February 2026, 100% operational hub for African mining services. Now the structure is like this. Lloyds Metal and Energy Limited, they have a subsidiary called Lloyds Global Resource FZCO, 100% owned. Now this Lloyds Global Resource FZCO owns 50% in Nexus Holdco FZCO, which controls 90% in Surya Mines and 8 others, total 16 mines. And their current copper cathode capacity is 12,000 tons per annum, expanding to 30,000 tons per annum. They have 49% stake in Virtus Lloyds Minerals Holding, which owns 100% of KMF Group 50 plus mining permits, 100%. So, and the 51% partner in this business is Virtus Minerals Group USA. So what they are doing is now piling on the US to get a good deal. Current copper cathode capacity of 20,000 tons per annum expanded to 70,000 tons per annum. Current cobalt capacity of 4,000 tons per annum and expanding to 20,000 tons per annum. So in the DRC, the group target is around 1 lakh or 100,000 tons per annum copper and 20,000 tons per annum cobalt. Assets are KMF, current and planned is in Mutoshi. So both are roughly copper for 70 and cobalt is around 20,000. So total it will become 100,000 here. From their various mines and copper cathode levels currently, clear picture to scale the plant to 30,000 tons per annum. And Triveni, which they have acquired, is expected to do MDO service for 50 million tons material, providing additional income streams. So Lloyds Cobalt debut entry into strategic and critical minerals supported by US. So this company is on the right side of US, so that is another advantage. Now, this is their last quarter results. Their income was up 3x. EBITDA was also up around 3.5x. And EBITDA margins improved by 320 basis points. The profit after tax was also 3x. Now, over 9 months, they have crossed 100 billion of revenue milestones. So they over 9 months. So this is not one quarter wonder. Over 9 months, their revenue has nearly doubled, and profits have also doubled. So that is a good improvement. Now, how are they going to fund this acquisition? That is the critical part. The primary engine for these acquisitions is the massive free cash flow generated by the Surajgarh iron ore operations in Maharashtra. With iron ore production hitting a run rate of 20 to 22 million tons per annum and margins expanding due to slurry pipeline, the company is generating enough surplus cash to cut 30 to 55 million dollars checks for international stakes without external borrowing. So in March 26, the company allotted over 1.76 crore shares through warrant conversions, raising 847.55 crore in single exercise. For African acquisitions like KMF Group deal in March 26, Lloyds Metal is not going in alone, so they have tied up with the US. By taking a minority but significant 49% stake for $30 million, it gains exposure to massive copper cobalt reserves while sharing the 200 million plus total capital commitment with its American partner. This also provides a diplomatic cover and reduces the political risk of operating in the DRC, that is Congo. It utilizes its wholly owned subsidiaries such as Lloyd Global Resource FZCO Dubai to execute these international trades. They are using their Indian iron ore profits to buy African copper. It's a simple thing. So because they have become efficient, they are making good profits from Indian iron ore and they are buying African copper from this, effectively swapping a domestic commodity for a global energy transition assets without burdening the balance sheet with high interest debt. So the more important thing to see here was cash flows. So if you see here, they are, despite all these capex and acquisitions uh, which are expected, they are cash flow. They would be cash flow fine because their profit before tax is pretty good because of Indian operations, and they have tried to reduce their debt, and so that has also reduced. So that is also good, though they have been able to raise equity, etc. So their cash flow position is stable. Hence, that is not a risk. Now, another thing which they have done is they have done a tie-up with Tata Steel to explore strategic collaboration. Tata Steel has invested into BRPL. Now, BRPL is Brahmani River Pellets Limited, wholly owned subsidiary of Triveni Pellets Private Limited. So ownership mirrors parent companies. Now, Triveni Pellets Private Limited also was acquired by Tata Steel for they acquired 50.01% stake from Triveni Earth Movers Private Limited. So what they have done is they have de-risked their business and reduced their debt and improved their cash flows by selling critical stakes to Tata Steel. And Tata Steel will buy pellets from them. So Tata Steel has acquired 50.01% acquisition of DPPL and execution of pellet conversion agreement. Cooperation across iron ore mining, pellet manufacturing, slurry pipeline infrastructure, and steel making focus on capacity optimization, cost efficiency, and security of raw material supply, aligned towards building a scalable, integrated, and sustained steel value chain. So it's a very good to utilize the complementary strength of Tata Steel to promote sustainable and efficient growth in the domestic steel sector. So they will operate together in mining, pellet and processing, logistics, and steel and low carbon production. So that is the advantage. Now coming to financials. So if you see here, the revenues became from 6,600 crores, it became 13,000 odd crores in FY26, so nearly doubled. It is going to go up by 50% in FY27 and go up more in FY28. EBITDA in FY26 has become nearly 3x, and it is going to go up 50%. Profit before tax also is going to go up by 50%, and similarly profit after tax. Now, in FY27, it is expected to do a EPS of around 103. Let's take it at 100 and around 68, 69 in FY26. So it's at around 1350 odd right now. So it is at 13 times with this kind of a growth. Sales growth expected is around 50%. EBITDA growth is 51.9%. EBIT growth 50%. PAT growth 50% for FY27. And right now, not much of the copper and cobalt, etc., is not coming into the business. That is expected to grow. So gross margins are going to improve. EBITDA margins are also improving. ROE is improving, 30 plus, 30, 32, 33. ROIC, etc., is very high. So it's a very good running business. Now, this stock is consolidating right now. It because of this news, etc., it went up on around 3% on Friday. But in my opinion, every dip is a buying opportunity in this stock because they are getting into very good business, and the internal fundamentals are also good. I finished. We will take questions now.